It's also important to focus the majority of the time and our attention on what actually matters. And that gets back to what are we doing here as investors? What is our goal? My goal is to make money. If your goal as an investor is not that, then I would find a therapist and speak to that person and find some help. The goal in investing, regardless of time horizon, short-term, day trading, long-term, what is the goal? To make money. Okay, so how do we make money? We make money by selling things at higher prices than where we buy them. That's how we make money. So if we're reverse engineering what the ultimate goal is with the best ways to accomplish those goals, which is make money, it's like, okay, sell things at higher prices than where we buy them. Terrific. Now, how do we do that? Well, we know for a fact, if you're into white papers, there's plenty of them, asset prices trend. We know they go up for a while, they go sideways for a while, they go down for a while, they go up for a while. And again, they trend on multiple time frames. As short term as you want, look at tick data, they trend. Look out, decades, and you'll see trends too. Up, sideways, down, the whole thing. Asset prices trend, we know that. So if we're trying to sell things at higher prices than where we buy them, maybe we should try buying things that are going higher. Or if we're shorting stocks, and again, when we're shorting stocks, we're still selling them at higher prices than where we buy them, if we're making money, of course, just not necessarily in that order. We're selling it first and then buying back at a lower price. So if that's our goal, to buy it back at a lower price, maybe we should be selling things that are going down, right? Because we know that that's the trend. So it's about recognizing the trend. Now, we're talking specifically about equities. By the time we get to our equity analysis comes within the context of a more macro intermarket picture. So before we even get into what the S&P 500 is doing, we've already gone and looked at every other country on the planet. Everything in Latin America, Mexico, Brazil, Chile, Peru, the whole thing, Europe, Sweden, Oslo, Helsinki, London, France, Germany, Spain, Italy, Greece, the whole thing, Austria, keep going, Portugal, we're looking at all of them. We're in Asia, we're looking at Korea and China and Hong Kong and Singapore and Taiwan and the Philippines and Malaysia and Jakarta, Australia, Canada, across the board. So by the time we get to the United States, it's like, okay, is the United States doing what those others are doing? Or is the United States behaving differently than those others are doing? Which regions around the world are doing the best? Which regions around the world are doing the worst? Maybe there's a country in a particular region that's very different than some of the than what the rest of the countries are doing, and that gives perspective. In each of these countries, there are different groups of stocks and companies that drive those indexes. So understanding which countries are working is also giving us information in terms of which types of stocks are working. For example, the United Kingdom has 0% energy exposure. Chile has technology. UK has zero technology. Chile is a mining and resources economy. There's no technology there, right? So if these sorts of countries are doing well, that's information versus countries that are more, I'm just using one example, right? If you look at a lot of these countries like Canada and all over Europe, they got a ton of industrial exposure. What do you know? Industrials in the United States are working great also. So looking at what's happening around the world confirms essentially, or gives a heads up that maybe we should be looking, man, Chile and Latin America, these things are ripping. Maybe we should be looking at more materials and mining companies and energy companies because Latin America is telling us something, right? For example, Europe is completing a top. Germany is breaking down to new 52-week lows. Japan is put in a failed breakout in a hypothetical situation. There's information that the rest of the world is falling apart and the United States might be hanging on, but there's a lot of other information of deterioration. That's part of the breath work that we do. And that's when, and at this point, we'll do the same thing with commodities. Every single commodity on the planet, metals, energy, agriculture, the whole thing. We'll do the same thing with all of the energies, right? Whether even in uranium and coal, but obviously the oil and the gas, heating oil. So by the time we get to US equities, it's like, okay, great. We already have all of this context to put what now we're looking at to be able to make money in the equities market and say, okay, now the S&P 500 made new highs. Terrific. How many stocks in the New York Stock Exchange are making new highs? Are we seeing more and more stocks making new highs, or are we seeing fewer and fewer? Are we seeing broadening participation or deteriorating participation? Because that is really what the market is doing. The Dow doing something or the S&P doing something or the NASDAQ doing something is only so much information, because there are formulas of stock behavior that will give you those numbers versus most people will not take the time to actually go stock by stock and count how many are going up, how many are going down. And that's the leading indicator. The indexes are lagging. It is the internals of the market that are leading. And part of the global macro look and looking at what all the countries are doing is part of that. What are all the countries doing? What are all the sectors doing? Financials, industrials, technology, materials. Are more of them making new highs, or some of them breaking down and making new lows, or more of them right? We do the same thing at the industry level, because just because you have healthcare as a sector, you got all kinds of stuff in healthcare. You got medical equipment, biotechnology, pharmaceutical, managed health. I mean, these are vastly different types of companies. In financials, you've got broker-dealers, you've got regional banks, you have insurance companies, you have capital market stocks. You've got all these different types of companies that have nothing to do with each other, and you see it in the trading. You see insurance stocks doing one thing and regional banks doing a complete other, and they're all in the same sector. Berkshire Hathaway is the largest component of the U.S. Financials Index. Understanding the composition of these sectors, something like technology, half of that is Microsoft and Apple. You look at consumer discretionary, a quarter of that is Amazon. But if you look at industrials, no company represents more than 4% of that entire sector. So it's a much more diversified sector. So all of these are giving you different information, and it's about weighing all of the evidence to be able to find out where's the strength. Are we buying strength? Where's the weakness? Are we selling weakness? Avoiding weakness? Where's the rotation? Sector rotation is the lifeblood of a bull market. We see that. We've been seeing that since last year. Remember, the new 52-week lows list peaked in June of 2022. Since then, it's just been broadening participation higher ever since. The back half of 2022 was actually very solid. Most stocks went up. It was much easier making money from the long side than it was from the short side. That was the beginning of the bull market. It's just that technology stocks and large cap tech weren't participating in that strength. That didn't come until January. So you got that sector rotation. In bull markets, the laggards catch up to the leaders. In bear markets, it's the opposite. The remaining leaders catch down to the laggards, right? What we've been seeing for 18 months, because we're recording this in January of 24, has been expansion in participation to the upside amongst countries, sectors, industry groups, and stocks. When that starts to change, fewer stocks are making new highs, fewer countries are making new highs, fewer sectors and industry groups are making new highs. When that starts to occur, that is likely to occur in advance of any major topping that could take place in this ongoing bull market. So that's how I look at technical analysis and why we do that bigger picture view.
You're taking a look at a more holistic set of, indicators, other markets, and using that as your data in order to give you insights as to whether or not you're going to feel comfortable, buying or selling a stock.
Before you do anything is identify what type of market environment are we in. That's it. Are we in a market environment where we want to be buying stocks? Which ones? Are we in a market environment where we want to be selling them? Are we in a high volatility environment? Are we in a low volatility environment, right? What does that look like? Because without that information, you can't decide which tools and strategies to implement. First, you identify the market environment and then decide which tools and strategies are best for that market environment. Why would you incorporate a strategy that works best in high volatility environments when you're in a historically low volatility environment? That wouldn't make any sense. Why would you be incorporating strategies that are good for bull markets when we're in a bear market? Why, right? You know what I'm saying? Like, these are the things that we want to think through. And without taking that holistic approach, how could we possibly identify what type of market environment we're in? Right? So first we identify the market, then we decide what we're going to do about it versus people just blindly, well, if this line crosses over that line, you to the moon,